Hello everyone, and welcome back. Really hope everyone is having a great day. Blackrock? Yes, it is the world's biggest asset manager. They were embarrassed on the first day by an XRP ETF that no one saw coming. And the more you look, the more painfully clear it is that the case for an XRP super run. Right now, it's building up faster than anything else in crypto. Let's start talking about this before everyone else finds out what's going on. Let's get right to it, because this is where things go from being interesting to being completely crazy. Blackrock, which is known as the final boss of traditional finance, debuts their new Bitcoin ETF with the hope of taking a victory lap. And Canary's Capital's XRP ETF beats them on the first day. Blackrock got about $111 million in new money. Add one more zero and call it $112. Canary? They come in through the side door with $245 million, which is more than double what they had on the first day. Also, thanks to Baron of Beach for catching this early. The real story was going on the XRP side, where no one was paying attention because the Bitcoin ETF launch was so exciting. People who believe in Bitcoin maxis are yelling because their whole identity is based on being the crowd choice. The institutions just made their point very clear. It's now on the board for real. The rules have changed. This is what most people don't get. Those coming in, that wasn't important. That was the warm-up. Before the show starts, that was the first scene. Things that are coming up behind the curtain in the next part of this story make those lines look like nothing. Now, if you really want to know how the top 1% are going about things behind the scenes, check out the XRP Millionaire Plan to learn how people think, how they allocate their money, and the step-by-step process they use to turn these cycles into life-changing wealth. In the comment below that has been saved, let's get back to it. The $20 trillion bomb is right there. That's right, $20 trillion. Trump also says in the most relaxed way possible that he thinks $20 trillion will flood into the U.S. economy in the next 45 days by the end of the year. When that much money comes into the market, it doesn't just rebound, it takes off and goes through the roof. And there is only one type of asset that is traditionally done best when there is a lot of liquidity and new rules are made clear. It's not stocks, bonds, or real estate at all. It's crypto. End of sentence. When you add in the fact that XRP had huge institutional demand on day one, that label of future institutional pick stops looking like a guess. That looks like the road we're already taking. The case for XRP isn't just coming together, it's moving quickly forward. Everyone is looking at Bitcoin because they think that's where the action is, but the real shift in power is going on in the background. Now that we've talked about being quiet, let's talk about what's going on behind the scenes. At first, everyone in the business just shrugged because Flare had just said something, but then the data hit them in the face. Hugo Fillion, one of the founders of Flare, said that VCs told him the XRP community would never use DeFi. Those exact words. Real life then hits you like a freight train. It's already March 7th for 70% of all the XRP that was linked to Flare in the last 5 or 6 weeks. Numbers like that don't happen unless something big is going on below the surface. That's not just attention, that's commitment. That's the kind of behavior you usually only see from insiders, whales, and early adopters who know how big what's coming is. Another thing is that Flare isn't just another chain. It's an EVM layer 1 built around data. Fully protected data protocols, price oracles, Web 2 and Web 3 data, all protected by stake and handled directly by validators. No need for a third party. They have been on board with XRP from the start for a very simple reason. Since XRP doesn't have its own smart contracts, it needs a chain with strong enough infrastructure to handle its growth if it wants to join DeFi on a large scale. As for assets like XRP that institutions want to be exposed to, Flare built the bridge, the oracle system, and the tracks. They did this without the technical mess that other chains have. Everyone else in the crypto world laughed and said that the XRP troops would never use DeFi, but here we are. There's no better proof than the fact that 70% of bridged XRP is sitting in DeFi. It's even more funny when you know that this group has been showing doubters they're wrong for more than 10 years. You're not going to get DeFi? Done. You'll never get ETFs, right? We just had the most money come into ETFs on the first day of 2025 compared to Solana. That's even though Canary isn't as big as Bitwise, whose hasn't even gone live yet. Take that in. Bitwise is the big one, and it's coming out next week. Canary is small. Do you want to talk about fireworks? Then things really start. Take a look at the Canary screen now. On the first day, more than 1 million ETF shares were bought and sold. A lot of action, steady demand, and the average size of a trade show that this wasn't retail. It wasn't hype. This was planned and measured accumulation. That fits right in with what Tom Lee is now putting more emphasis on. He just said again that the S&P is on track for a strong end to the year. He says that seasonal strength is here, earnings are good, and sentiment is bad. This is exactly when markets turn around, and the risk-reward is strongly in favor of going up. He also says that the S&P could go above 7,000 by the end of the year, or even earlier. After all of that, Bitcoin is still making progress toward closing the huge CME gap around 92,000. Since 2023, every single CME gap has been closed. Bitcoin is now moving right back into that area. As long as that gap closes, Bitcoin is not showing signs of weakness. It's the placement. It's getting ready. And this is where the whole crypto market gets it wrong, because people are scared. People respond too much. There is bad news when they see a red light. In the meantime, organizations are laughing. In a relaxed tone, Eric Trump says on stage that Bitcoin could reach $1 million. It doesn't matter if that's 5 years or 15 years. It's the same math. That's a 10 times chance, even from where you are now. Usually, it takes 7 years to make twice as much money in the stock market. Crypto lets you use multiples that aren't available anywhere else. But store panics, they feel tense. They make money. While they were freaking out, someone walked in and grabbed $64 million worth of Bitcoin like it was a Costco pizza. There was no hesitation, no fear, just firm conviction. It's not in that buyer's mind to have a bad day, week, or even month. They have a plan for the next few years. Retailers are yelling that the bull market is over, while whales calmly buy on every dip, just like they've done every cycle. It's the same trend this time, but there are more numbers and bigger players. Now the officials are also changing. And the timing couldn't be better for the story of XRP. The head of the SEC, Paul Atkins, said on national TV that the agency is working to loosen crypto rules instead of making them stricter. Relax. He also made a digital taxonomy that finally separates digital goods, digital tools, digital collectibles, and assets that are tokenized. Was that clear? That's the exact kind of regulation that XRP was designed to work in from the start. This is the point at which utility tokens stop being cool and become useful, and the market is already responding. About 149 million XRP, or $336 million, have been taken out of platforms in the last 24 hours. There aren't any small traders there. That's organized accumulation. Also, look at how XRP stayed strong while everything else went up and down. When supply goes down and price stays the same, it's generally the upward breath before the upward exhale. Let's move on to JP Morgan, because you know something is changing behind the scenes when big companies that laughed at crypto for years start calling bottoms and predicting new highs. JP Morgan now thinks that the bottom will be around 94,000 Bitcoin and that it will hit 170,000 by 2026. That's not a forecast from an influencer. There is no trader on Twitter like that. That being said, this is one of the world's most conservative and anti-crypto organizations. Not only are they becoming optimistic, they are making it known to everyone. This has happened many times in the history of money, and each time it means that the build-up phase started in secret, long before anyone knew what was going on. They never say out loud what they're going to do next. They only talk about things they've already done. This means that when big players start putting out bullish goals in mainstream media, it's not speculation, it's getting ready. The public is getting ready for a move that's already happening. So the process of strategic positioning has started. That means that ETFs are steadily taking in new money every day, which reduces supply while boosting exposure. This means that stories are slowly but surely becoming more in line with each other. This cycle, the focus isn't just on Bitcoin. More institutions are now looking into how liquid XRP is, how its network usage is growing, and how its infrastructure is getting better. There is a reason for the change in attention. It's a sign that the next stage of adoption is already taking shape and is just waiting to come out. Remember that ETFs change the way the market works as a whole. They keep putting pressure on people to buy every day. Because those ETFs don't wait for mood, they get rid of the old 4-year cycle for assets that use it. They just buy. On red days, they buy. When the weather is good, they buy. They buy when prices are low. If the market is closed on the weekends, they buy. But orders for institutions are already sitting in line for Monday. This changes markets that hold assets with ETFs into ones that are driven by flow instead of feeling. The first signs of this can already be seen in Bitcoin. Next is Ethereum. XRP is the first non-Bitcoin ETF to enter this world with the fastest day one growth this year. It's like a pressure cooker. When you mix ETF flows with national liquidity injections, dropping exchange rates, whale accumulation, and loosening of regulations, everything builds up until the market stops moving. It snaps up. This setup we're looking at now has that exact mark. Now look at how the market acts. There is a huge gap between how people feel and what is really happening. Retailers think crypto is having a hard time. Stores believe that Bitcoin is getting weaker. Consumers believe that instability means a fall. The numbers, on the other hand, say something very different. Bitcoin is perfectly bouncing off trend support that goes back many years. The chart moves up and to the right, almost like it's following a story that was written years ago. The long-term system is still there. The trend can't be denied, even when things change. But shopping still gets shook up every time. Some say that this time is different. In reality, though, this time isn't any different. The only difference is that the numbers are now bigger. The schools and colleges are bigger. It's a bigger market. But how people act, the same as always. Whales make people more afraid. Fear is sold in stores. Institutions wait for the right time, and that ideal time is when there is little money available. People are feeling bad. The new rounds are a mess. Stores believe the run is over. And while everyone is scared, the blockchain data shows the exact opposite. Large amounts of XRP are being added to accounts faster than they were earlier this year. The sums of exchange are going down. When wallets go to sleep, they wake up. More OTC business is happening. Ripple's actions on the blockchain show changes in strategy. Moving to custody options that work with institutional partners, not selling. When you lay this out, you can see the same pattern that always shows up before a leg up driven by liquidity. But something else is going on too. Something even bigger than how prices move or how whales move. The world around XRP is changing all the time. Flare is just one example of this. Smart contract layers, DeFi liquidity pools, staking systems, and tokenization rails are all growing faster than anyone thought they would. What was once academic is now useful. What used to take years to happen now happens every week. In the early stages of mass usage, this is how infrastructure grows quietly while stores don't notice. At the same time, after months of instability, global markets are starting to settle down and capital's moving back into risky assets. The question isn't whether markets will rise, it's which areas will rise the most as $20 trillion comes into the US economy. Technology speeds up. Risk assets grow. Crypto not only comes back, it soars. But the assets that really do better are always those that are in the middle of utility, liquidity, and legislative alignment. That's the formula that banks look for when they put big amounts of long-term capital to work. And XRP is right now in the middle of that sweet spot. It's designed to work in the real world, has growing liquidity lanes to back it up, and is becoming more in line with the rules that matter for global finance. As more money comes into the system and markets start to grow, investments that are useful to people usually lead the way. Now, XRP isn't just going with the market, it's set up to describe the next one. Each of these signs is important on its own. A symmetric opportunity, on the other hand, is when they all line up at the same time. This is the kind of chance that experienced buyers wait years for. The kind where everyone says it was clear after the fact, but most people missed it at the time because they were sidetracked by other noises. That sound is very loud right now. People are calling it tops, crash, and doom. It happens over and over again in the same way. But the facts are true. Flow of money doesn't lie. It's not a lie that institutions accumulate wealth. Narrative changes and regulations don't lie. The flows of ETFs don't lie. The numbers don't lie either. Crypto isn't getting weaker. Crypto isn't going away. Crypto is getting ready. And XRP is showing all of an asset's signatures, getting ready for speed. How perfectly timed everything is what's so interesting. The global environment changes from tightening to easing just as institutions warm up, whales gather, and rules become clearer. Setting up could not be more aligned. Even though the market as a whole isn't paying attention, XRP is still making a name for itself as the asset that is ready for trading, friendly to institutions, and scalable around the world. The story gets even more interesting now. Bitwise will take over next week. It is a huge ETF player that is much bigger than Canary. If Canary made more than $245 million in its first day, just think what will happen when the heavyweight shows up. That's when the real ETF battle starts. After that, other service companies rush to catch up. That's when stories change from saying that XRP has an ETF to saying that XRP is becoming a common way to trade. And when the story changes, the capital comes next. It always does. Big money doesn't follow the talk. It goes after infrastructure. It aims for regulation alignment. It looks for cash. In 2025, XRP will be the first non-Bitcoin asset to be able to check all of those boxes at the same time. This is even showing up in the way people trade. XRP holds up better than expected. Even when it goes down, the structure stays the same even when there is instability. Even when other investments are losing value, XRP keeps coming in. That's how an object looks when long-term investors, not day traders, are looking to buy it. That picture is very different. That's on top of the fact that banks, fintech companies, global payment rails, and new institutional partners are all adding or trying settlement and tokenization systems. One of the hottest stories in banking right now is tokenization. XRP is also a good balance between regular markets and blockchain rails. The world is moving from slow, separate banking systems to digital settlements that can work with each other right away. When that happens all the time, things that were made to be useful and efficient will be at the front of the line. This is not advice about money. It's very clear that we're not just talking about a new financial product. When you look deeper into the XRP ETF topic, we're talking about a structural change that makes the old system listen to what crypto buyers have been saying for years. It's important to think about utility and liquidity, and speculation would never be enough to decide the future of global payment. Institutional ETF's entry into this field does more than just give it more credibility. In other words, it changes how demand works. It changes XRP from something that buyers can trade into something else. In order to meet inflows, reporting standards, and regulated custody mandates institutions must hold. Things like quantity, velocity, and availability will never be the same again after that change. People still think of ETFs as just another way to invest, which is the biggest mistake I see right now. They're not. ETFs work like empty financial spaces. When they start to build up the core asset, they don't trade it based on emotion, panic, rumors, or hype. They do what the rules say, they go with the flow. They do what they are told. This is what makes XRP different from all the other crypto projects out there. Because XRP is connected to the infrastructure of financial settlement, while Bitcoin and Ethereum are based on ideas or developer activity. When a new investor buys an ETF, they are essentially connecting to the same system that banks, money transfer giants, and liquidity hubs are starting to look into on a large scale. This is why the discussion about the form of ETF shares is more important than most people think. If each share is worth a set amount of XRP, and those units need to be backed, stored, inspected, and kept up to date, then the issuer has to keep buying real XRP on the open market. You can't skip this. This can't be changed. Issuers can't skip this. The way the ETF is set up drives real acquisition. And because most regulated systems allow shares to be redeemed, the issuer must always be ready for both money coming in and going out. That means they need extra space. They need to save money. They need partners in cash. And for XRP, liquidity doesn't just come from traders. It comes from the fact that Ripple keeps growing behind the scenes. Most experts don't look at this layer. Once an XRP ETF is in institutional-grade storage, banks, payment providers, and cross-border liquidity operations can all use the same infrastructure. This is the multiplier effect that you can't see. When a big issuer sets up custody rails for Bitcoin, those rails don't immediately turn Bitcoin into a settlement asset. Bitcoin is just kept. XRP storage, on the other hand, can connect to real payment flows, real conversion paths, and real on-demand liquidity. On the other hand, the infrastructure that is being built opens doors in fields other than trade, while the market is busy treating this like just another ticker symbol. At this point, it's impossible to ignore the long-term goal. Then think about this. ETFs don't look for fluctuations like individual traders do. They look for long-term positioning, security, and structure that they can count on. And XRP is really in line with that way of thinking. It's not tied to hype waves. It has nothing to do with mind stories. It has nothing to do with mimetic culture. Its main job is to be a settlement asset with high efficiency that institutions can depend on for moving value around the world. Cryptocurrency XRP is like digital cash. Bitcoin is like digital gold, and Ethereum is like digital infrastructure. And digital currency is the one thing that businesses can't do without. This is the reason why a spot ETF is more important for XRP than it ever was for Bitcoin. The product fits XRP's real-world role. And here's something else that people miss. ETF providers don't just put out a fund and leave. They do the marketing, teach advisors, meet with institutions, set up sales channels, negotiate to be included in model portfolios, and set up partnerships to get more people to use their products. Think about the biggest banks in the world actively marketing. Not guessing or chatting around, but pushing. An exposure to XRP that needs XRP acquisition. When something is exposed to it, it causes demand that is not based on feelings, but on how things are set up. That kind of exposure that doesn't go away when Twitter is negative. This is why discussions about shortage, availability, and liquidity depth have come up again, but this time they are more heated. Because demand isn't just a thought for the first time ever. It's not if. It's not one day. It works by itself. It's written down. It's built into the structure of the ETF. Remember that they need XRP to give out shares. They need XRP to cash in their shares. To fix things, they need XRP. And because XRP's circulation is already unusual, with a lot of it locked up, escrowed, or held for a long time, the amount that is actually available for institutional use is much smaller than what most people think. This is because retail investors have never really seen what happens when institutions chase an asset with limited circulation. But they're about to find out. One more thing. The people who make ETFs don't fight over who has the best ticker. They compete to see who can give the most reliable exposure, the most liquidity, and the tightest spreads. In other words, they make over-the-counter deals, liquidity partnerships, and custodial agreements, all of which need one thing. There is more XRP being managed. And as more companies come into the market, they will all get their money from the same pool. There isn't another form. It's not possible to get another item. There isn't a second pond. The market is the only thing there is. Now is the point where everything starts to come together. Structure of institutions, how ETFs work, usefulness of settlement, infrastructure for custody, and the long-term goal that Ripple has been working toward. Not a single piece is picky. Not a single piece is by chance.